Italy. Stunning culture, great food, historic cities, but there's a darker side to Italy, their economy. Stagnant growth, high debt, and even a full blown debt crisis following the GFC. Could the US be headed down a similar path? In this video, we'll take a close look at Italy, brief economic history, their yield curve, fiscal struggles, and more, while comparing it to America's own debt story to see what lessons can be learned and what parallels there are. So, coming out of World War II, the developed world had very high growth. This applied not just to America, but to Italy as well. You can see here in white, this is the inflation rate for Italy, and green shows the real GDP growth. And you can see that real GDP was above 4, 5, 6, even as high as 7 or 8%. And again, this is inflation adjusted growth, the green line. Um, and inflation was, also relatively high. We can see here in the early 70s, it reached a peak of about 7%. But look at what happened into the mid 70s. Just like in America, inflation ripped higher. In fact, at its peak here, inflation was 25% year over year. Here, the peak in 76, it was 22%, as it was in 1980. But in general, you had these cyclical kind of downturns, the business cycle, and these cyclical downturns where growth would fall, inflation would fall, and the economy would kind of contract. But in general, you had high growth and high inflation. And look at what happened, kind of ever since then. Not only did real growth fall, but inflation fell as well. When inflation is falling, when it's still inflation, right? Prices are still rising, but they're just rising less quickly, which is this white line declining. That is called disinflation. That does not mean prices are going down. That just means prices are rising at a slower rate. This is what we've seen in America the past 4 or 5 years. Well, here is the 2 year yield. And unfortunately, this data only goes back to 1989, but we can see the Italian 2 year yield, cost of the debt. Look at the difference between inflation and especially real growth. Look at the difference between the cost of the debt and inflation. So remember, if you're a government and you have to pay 780 basis points of yield on top of inflation, right? If you're government, you want this inflation rate to be higher. But if you're a bond investor and you just came out of this, uh, 15, 20, 25% inflation, you're going to demand a higher premium. Sure enough, that's exactly what happened. We can see that there was, this very high premium being demanded. Well, there were some issues politically in the 90s. And of course, we know the effect that has on the debt to GDP when the government is forced to pay a super high premium over the rate of inflation. We can see what that does to debt to GDP. It started at 90% here in 89. And reached a peak of 121%. Well, there were some issues, some political scandals in 1992. There were issues where they had to devalue the currency. This was before the eurozone. But then heading into the euro adoption and the proposed eurozone, there were requirements in order to meet the criteria to be allowed into the eurozone. We can see debt to GDP was 122%. We're not sure what the deficit was, but I'm sure it was up here. This is inverted, by the way. So as this light blue line is going up, the deficit is getting worse. Remember, Italy, 120% debt to GDP or a 5% budget deficit in Italy is not the same as it is in America. America has this exorbitant privilege, the reserve currency issuer, all those things that are talked about kind of exhaustively. I would argue they are declining and kind of coming to an end, but that's a separate point, a separate video. But in order to be adopted into the Eurozone, they had to enact austerity measures. And sure enough, that's what happened in 95. And we can see the deficit declined from a pretty insane 7% of GDP all the way down to a very modest, relatively healthy 1.8% budget deficit. Debt to GDP also declined. Well, look at what happened to the premium over inflation that the bond market was requiring. It went from requiring 700 basis points, actually 750 basis points over inflation, to here when the deficit reached that point, we can see the difference was only about 100 basis points. So this made financing the debt much easier for the government. And because that premium, right, the inflation rate, the cost of the debt was coming much more in line with the inflation rate. And again, note the kind of cyclical business cycle when it comes to real growth. So here is just a side by side, just to give you an idea. Most of my viewers are American. Here is real GDP year over year for America in yellow, and Italian real GDP in blue. Again, the same general trend of kind of falling growth coming out of World War II. Here we will look at inflation for the two countries. So here in red is the U.S. inflation rate. We can see this goes all the way back to 1948. High inflation, right? We thought the inflation in America was probably bad at 12, 15%, but look at what the inflation rate was in Italy. And again, same is true here in the 60s. I mean, Italian inflation was like 8%. American inflation was only 1.5%. So there is a side by side. Okay, couple major points. So we established that the 2 year was falling, right? The government was enacting austerity, debt to GDP, and the deficit were falling, kind of heading into the euro adoption, which happened in 1999. That was when the euro was officially adopted. I can mark that here with another yellow line in 1999. This is when the euro was adopted. So here, this first line that I marked here, right here, this is you had the 2 year at about 4.5, and you had real growth at about 1.2. Not great. This was the top in the S&P 500, the summer into the fall of 2007. And we know what happened with the GFC here in America. Well, this affected the whole rest of the world. And you can see what happened to real growth. Real growth for Italy fell off a cliff. And at the height of the GFC, was as bad as the economy on a real basis was shrinking 7% per year. This was, much worse in certain countries than but in general, the entire world kind of felt that GFC. Well, as is to be expected, here we can see the 2 year treasury yield, excuse me, 2 year bond yield for Italy fell, and this is what normally happens. But look at the difference between how far real GDP fell versus how much the yield fell. This gap, that which had converged, right, due to the kind of austerity measures, um, in the 90s, you had gotten the real growth rate and the cost of your debt much more in line. But then look at what happens. You get plunged into this great financial crisis. Your growth falls much more quickly than the cost of your debt. So here is 2007. Right here, their deficit as a share of GDP was 3%. In the height of this is kind of when the S&P 500 topped. Their deficit had gone down to about 1.5%. Their debt to GDP had an absolute low, kind of right as the S&P was topping, of about 100%, 102%. And then the GFC took hold, right? We established that gap between inflation and growth widened, and the same is true for the 2 year over not only real GDP, but the gap, the difference between the cost of your debt and nominal growth widened. What this means is, this is normal, but you see the deficit increase. Unfortunately, Italy's starting point was 102% debt to GDP. So they were already heavily indebted. Their deficit rose from 1.5% all the way up to 5%. Now, for America, who's currently running a 6.5% deficit, headed towards 7.5, utterly insane pro cyclical deficits that we've been running for the past couple years. This might not sound like a lot, but remember, Italy is not the reserve currency issuer of the world. And so the effect of running a 5% budget deficit on Italy is going to be much sharper. Then look at what happens to the 2 year yield here in red. Look at what happens very short. Look, this is when this fiscal deficit kind of blows out to 5%. Look at what starts to happen to the 2 year yield. So you see the 2 year yield just start to go like exponential. Well, what happened? So there was something that was different that was going on in Italy than anywhere else. Well, in Europe, there was the pigs crisis. We did not experience this here in America, but there was this kind of more localized sort of experience in certain European countries: Portugal, Ireland, Italy, and Greece. Um, Called the pigs crisis, PIIGS. And this was a debt crisis. This was a sovereign debt crisis in these countries. And here we are looking at the yield curve. And so this is how I normally do it, right? The shorter term maturities are kind of the lighter colors. And as you get darker out the rainbow, that is longer maturities. And then this white line here shows the spread between the 30-year and the 2-year. And this is all one scale. This is all one scale. So look at what starts to happen, right? The spread starts to flatten. This is called a flattening. Well, when it occurs as rates are rising or bonds are selling off, this is called a bear flattening. We do not see this very often. I think this is important to point out. One of the cool things about Italy that we can look at here, this bear flattening of the yield curve. You don't generally see that in America. This is when you have severe kind of concern, right, over the very, very short term. You can see the 2-year, all the yields were rising here, right? From 2010 into 2012. You can see all the yields were rising, but the 30-year didn't rise nearly as much as the 2-year. Look, the 2-year went from 3.4 all the way to a peak of like 8% in a matter of like a couple months. You can see the 30-year rose, but it rose much more modestly. And this white line shows the difference between those two yields. Well, in fact, it actually went negative. And I will put a line here at 0% so we can see that. The difference between the 30-year and the 2-year actually went negative. Now, remember, generally you would expect to get higher yield, more compensation for the longer term debt. The longer term debt is much more volatile. Number one, you're exposed for a longer period of time to inflation and various risks. So generally speaking, if you're going to loan someone money for 30 years, you're going to demand a higher interest rate than for short term. Hopefully this makes just kind of intuitive sense. Well, look at what happened to the difference between the 30 and the 2. It was positive, right? But what started to happen, it actually went negative, meaning the 2-year was actually a higher yield than the 30-year. Why does this happen? Well, if you are imminently concerned about the like imminent health of your country in the imminent future, you're going to demand a higher premium for very, very short term bonds that might mature in the next year or two. If the country is going through a crisis and you think the government might fail, they might default, that sort of thing. The risk in the next 1 or 2 or 3 years is much higher actually than it is in 30 years. And we can see, yields rose across the yield curve, but they really rose at the short end. And this is called a bear flattening. Um, actually the spread went negative. And this is because, if you are buying a 30-year bond in Italy, you are thinking ahead to, well, yeah, things might be bad now, but they'll get their stuff together. They will figure it out. We will, elect the right people and we will get them in power and everything will be okay. No big deal. It's 30 years away. So, yeah, yields might rise, but they're not rising nearly as fast as someone who's buying a bond going, oh no, I don't know if the government's even going to be solvent when this bond comes due. Because remember, every bond comes due, there's this maturity where the bond holder must be paid back. And so what happened, what really kind of kicked it off was in Greece. And so here we see the Greek tenure in this lower part of the chart. This is the Greek 10-year yield, and it really started in Greece. And we can see that this bottom here in 2009, this was kind of the height of the recession, the global recession. You can see here this Italian, the spread between the 2-year and nominal GDP, right? Nominal GDP, real growth was falling all over the world, and the cost of the debt spiked, right? This is why we saw the debt to GDP spike, was that real growth fell off a cliff and growth is the denominator in the debt to GDP. So real growth was falling very, very sharply. Um, and so anyway, this was kind of the height of that, contraction, the height of the recession. The Greek 10-year was trading at about 4.8%. And then it started to rise quite rapidly. Here, by August of 2010, it's already at 11.5%. Now, sure, there was some recovery going on, but not much, right? There was already starting to be kind of issues, sovereign debt issues in 2010. But then look at what happened from June of 2011. It went from 15.3 all the way to like 36, 37% in a matter of a couple months, the Greek 10-year yield. This is kind of the heart of the crisis. And you can see here what happened to the yield curve in Italy, right? Sure, it might have started in Greece, but investors start looking around going, well, if Greece is kind of going bankrupt and there's this sovereign debt crisis here, what other countries might be heavily indebted that might have issues? Because real growth was falling. Remember, the deficit was quite high at 5%. This all happened kind of one after another, and I would argue they're all interconnected, right? From they were able to improve their deficit down to 1.4% of GDP, very healthy. Growth was, robust, 1.7%, 1.6%. Inflation was relatively moderate, 1.7%. Well, then, 2008 hits, the GFC, the global recession, growth falls off a cliff. They have to run this huge deficit as a share of GDP increase all the way to like 5.2% of GDP, which for Italy is a large deficit. You can see that the cost of the debt rose rapidly. We were looking at that here, right? This is the difference between the Italian 2-year bond yield, the cost of the 2-year debt, and nominal GDP. And we can see heading into 2008, it was barely, it was negative almost. It was zero. The premium over nominal GDP was not very high at all. And then what happened? Because growth, which is the denominator, fell so rapidly and the 2-year yield fell, but just not as fast, the cost, the real premium above nominal growth, we've pointed this out in numerous circumstances here in America too, going back historically. This is generally what happens. You have the cost of the debt rise much more rapidly. Well, everything is falling, but the cost of the debt is not falling nearly as quickly as your GDP. And so what you get is a widening of the cost of the debt over nominal growth. You get a widening. And we can see at the peak here in the summer of 2009, it was 8%, meaning the Italian 2-year yield was 8% higher than nominal growth. This puts a huge debt burden on your country, especially when we've established here that, their debt to GDP was already like 105%. So you are already pretty heavily indebted. You have this kind of spike right from 2008. Sure, there's the recovery, and we can see that, as nominal growth starts to rise, this premium of the 2-year over nominal growth that starts to come down, right? So the debt becomes kind of less burdensome as you start to grow, right? Because remember, the economy was able to recover here, and real growth did pick up. So you saw, a decrease in this kind of debt burden of the cost of the debt over nominal growth. But then what happened, right? We actually got negative where the 2-year yield was actually negative, right? Below nominal growth. This is actually, relatively okay for most governments. But then what happened? The Greek 10-year yield, by this time, the Greek 10-year yield had already been rising. Sure enough, the contagion hit kind of here in about May of 2011. And the yield started to spike everywhere, not just in Greece, but also in Italy as well. And so we can see that here. Remember, this is the bear flattening. You can see that reflected in the white line where this goes negative, where you're getting less yield on the longer maturities than you are on the short ones. This is imminent concerns of fiscal health, right, and ability to service the debt. And so, in fact, this caused the prime minister to resign. So here in December of 2011, it was actually November, but here in late 2011, the 2-year yield was 4.78%, and real growth was falling, right, because of austerity, and so this forced the prime minister to resign. And when the prime minister resigned, he was replaced with kind of a technocratic leadership, where they were much more kind of focused on austerity. They were much more focused on kind of ensuring the fiscal health. And so that happened in December of 2011. They were introduced. They introduced austerity measures, and we can see what happened to real growth. Right, it was just so ever negative here as the prime minister was resigning. It was just about zero, and those austerity measures, which when people say austerity, they mean raising taxes and lowering spending. Um, when you are a heavily indebted country like Italy, I will keep pointing this out, and you start to enact austerity, sure, that is good for your deficit as a share of GDP. But because of how levered the economy is, that puts your country into a recession. Again, this is one of the reasons I faded the whole, oh, we're going to balance the budget and cut $2 trillion. No, you're not, because I did the math. And if you did, we would see a similar recession like this in America. It just was never going to happen. And you see the debt load increase, right? So now, by 2014, their debt load is as high as 135%. This is higher than America is currently. And this is what happens with austerity. Sure, you might be able to bring the deficit down, the difference between government spending and government revenue. But because of how highly levered your economy is, this brings down your growth rate. And remember, GDP is the denominator in the debt to GDP. So this increases your debt load. You can be running a smaller deficit, but you're still running a deficit. And if your growth rate, your overall economy is falling so quickly due to austerity, that will cause debt to GDP to actually increase. And that's what we see. We see that the deficit as a share of GDP decrease here, right? The deficit decreases all the way back down to 1.5%. And Italy just can't catch a break. It increased down to 1.5% in December of 2019. But what did we see with debt to GDP? It actually increased. So governments get themselves into a situation that is hard to get out of. Now, of course, it wasn't just Italy that kind of enacted austerity measures, right, which had a negative effect on growth. It's not just Italy, but they were part of the eurozone, and the ECB stepped in. I think this is the Mario Draghi, whatever it takes comment. This is where it comes from. I'm pretty sure. And they announced this program called the outright monetary transactions. This is to stabilize the bond markets, and this happens in September of 2012. So September of 2012 is here. Yields had started to rise again after initially kind of starting to decline. Yields started to spike again, and this is when the ECB stepped in with this outright monetary transactions program. They always have crazy acronyms and names. It's basically money printing to buy bonds. This is when they stepped in. Was September of 2012. You can see this is the peak in the 2 year. It had gone from 1.9% all the way up to 4.7% in a matter of like 6 months. The ECB stepped in with this program, said we will print the money to buy the bonds. And again, you can see the yield curve had started to flatten out again. It didn't quite go negative. But it did start to flatten pretty sharply. As soon as that ECB program was announced, the yield curve started to revert much more to kind of a historical healthy range. Hopefully that's clear, as you can see in the white line. About three to 3.5%. This is kind of at least for Italy for this time period, kind of a healthy spread for the 30-year, a premium to hold the 30-year over their short-term debt. And then the last point to point out, they also started to kind of go through similar issues in 2018. They actually saw a populist government elected, right? Which kind of started to cause some of the same problems. So in general, populist governments spend a bunch of money that they don't have, and we can see what happened to short-term yields. They rose rapidly. You can see this white line fell, right? This is the yield curve is flattening. There were kind of starting to be concerns over the same kind of pigs debt crisis that we were talking about here that started to happen with the election of a populist government. We saw, all yields were rising, right? So this is a bear flattener because all the yields are rising, but the short-term rates are rising the fastest. This is called a bear flattening, and that is why this white line comes down, is because the yield curve is flattening. So I wanted to also compare. Here's the euro, which obviously, pigs, Portugal, Italy, Ireland, and Greece. There are many other countries in the eurozone that are part of the euro. That being said, here is the euro USD cross. Here is the peak of that bear flattening, right? The peak of the panic as the prime minister is forced to resign. We can see the euro was kind of under pressure here from a peak of about 145, fell as low as 123. But here's a spread. So here in blue is the Italian 10-year spread minus the DE stands for Germany. So minus the German 10-year yield. So what this blue line shows us, the red line is what we've kind of been looking at on the yield curve here. This white line, right? That is it's the same spread, the Italian 30 minus the Italian 2, but this blue line is the Italian 10 minus the German 10. And what we can see, when a country starts to go into, if you are trying to evaluate a country's economic or fiscal health, this is one of the things you can do. You can look at the spread between the yield on a similar maturity, right? So we pick the 10-year, you can look at the Italian 10-year and compare it to the German 10-year. And sure enough, look at what happened during the pigs crisis. Italian yields went from being only about 1.5% higher than German. They were kind of always higher than German yields. But look at what happened in the height of the crisis, right? When the yield curve almost inverted, right? And that bear flattening got really extreme and the prime minister was forced to resign. Look at the premium that was being demanded to hold Italian debt over German debt, right? The blue line is Italian debt minus German debt. Investors started to demand a 5.3% premium to hold Italian debt versus the same maturity for Germany. So this is one of those things that you can look at to kind of compare and start to think about flows. Because when yields are rising, that means people are selling bonds. When people are selling bonds, generally speaking, they want to rotate that money into something else. And this is one of the ways you can try to evaluate that. And especially when you start to compare it to currencies, interest rate differentials versus currencies, this is one of those ways you can kind of track global capital flowing around. Is you can see that, right? If all that money that was coming out of Italian bonds, because yields were rising, right? People were selling Italian bonds. Well, now they have euros, and guess what? There's other European countries like Germany that are in a better fiscal health that you don't even have to convert your currency to anything. You just buy them with euros because you're in the eurozone now and everything's euros. And sure enough, that would bring the German 10-year down as it's pushing the Italian bond up. And so this is when you get that spread starting to increase. You can see that it was actually already starting to increase even before the height of GFC. It was already kind of on this trend. This, generally speaking, is one way to evaluate kind of the fiscal risk of a country versus another country. If investors are demanding 5% more to hold Italian debt than they are to German debt, that is a signal that the Italian debt is much more risky than the German debt. Now, there's always people willing to take risks, and sure enough, you will see that. Here is the yield curve in America. Here's R30 minus R2, and in general, you can see that they kind of directionally, as the globe has become more kind of interconnected and the economy and the financial systems more interconnected, you can see they track each other in the late 90s into the early 2000s. But then you can see how notable this divergence is. This white line is the premium to hold US 30-year bonds versus US 2-year bonds. You can see when that bear flattening happened, because of the kind of imminent fiscal solvency risk, you can see how notably that diverged from the American 32 spread. And generally speaking, kind of since then, again, has traded directionally kind of in line with the American 30 to 2. So I think that's everything. There's a lot to touch on here. Maybe we could do a video on Greece. I probably missed a bunch of stuff, but hopefully that was educational, and I will catch you in the next one.